Borrowers may be scrambling to cope with all the rate hikes of the last 7 months, but savers are having the best time since the turn of the century. They're finding interest rates actually interesting for the first time in a long time. Let's bring in Jeannie Lee with more on that. Jeannie, great to see you. Happy Monday. What kind of rates are we talking about?
Well, we're talking about rates, Hannah, that we really have not seen sustained for much of a time. Since basically the late 1990s. We're going to show you a chart that goes back 25 years, and it shows you the interest deposit rate at the Bank of Canada. This is the interest rate that on average people receive when they deposit money at the commercial banks. Today it has hit 4.5% roughly, and you'd have to go back, like look at that level there. If you just drew your eyes back about across that graph, you'll see that we really haven't had a 4.5% rate since the recession of 2009, and before that they were higher, but not for a very sustained period of time. You would actually have to go back to the beginning of that graph, the late 1990s, to see rates, the savings rate or the interest on savings rate, higher than 4% for any amount of time. You'd have to go back to the late 90s. So, you know, you're seeing that, and what does that translate to? Well, GICs, guaranteed investment certificates, which for so long were really just torture for savers because they were offering very low interest rates, about half of 1% in some cases. Well, this is what you can find very easily. I just went through various websites of some of the lenders and savings banks out there, and this is what I'm seeing: 5%, 5.2%, 5.3%, and this really has not happened in a very long time. And again, that comes with the fact that interest rates have been rising for borrowers, but the flip side, Hannah, is that they are also rising for those who actually have money to save.
That is a little bit of good news there, Jeannie. When rates are at this level, what impact does that have on personal finance decisions?
Well, that's the thing. When rates were practically zero, it was much more fun to borrow money than it was to save money, because what were you getting after taxes? Practically nothing. And so that means that what we're seeing now is rates that are at a level where it encourages savings, and that in itself is a way to fight inflation. And when people put away more of their money, then you have less money being spent and creating more inflation or igniting inflation. Those who are on fixed incomes really had suffered through the whole period where we saw rates at practically zero. Now, 5% doesn't beat inflation yet, but if the rate does go down, then at some point, people who lock in some of these GICs at more interesting rates will be actually in the money. And so, you know, that hasn't happened in a long time. And 5%, Hannah, when you see what's been happening with the stock markets that we follow just about every day, you see that 5% guaranteed, safe, is not bad when you consider that the Canadian stock market dropped by 9% last year, and meanwhile your stomach acid is, you know, boiling away there, churning away.
Yeah, absolutely. So about that rough stock market, how's it going today so far, Jeannie?
Well, less rough simply because these markets have been beaten up so much over the last 10 months or so that a little bit of recovery isn't a big surprise. And we've had two fairly strong days, 135 points added to the TSX composite. The S&P 500 adding 1 full percent, so getting back closer to the 4% level, 4,000 level. The NASDAQ market adding 205, so a gain of 2% on the day. Canadian dollar at 74.81 cents US, so it too is rising along with the price of oil. As you see there, oil, the two oils we track, are continuing to warm up, shall we say. So there you have it, Hannah.
Thank you, Jeannie.
You're welcome.